your ability to repay that debt, or your sort of, if you think of like if you're buying a house, the bank looks at the income that you make and they look at, what the debt service coverage is on the loan you're going to take. It's the same thing actually with countries and governments and large
Yeah.
institutions, right? So you can think of like the United States is like one person, right? And our GDP is, I don't know, $30 trillion. So
Yeah.
you think of
Yeah.
like the US is like a household that makes $30 trillion, but now we have this debt that's way over $30 trillion. I think it's like $36 trillion, and it's growing by a couple $1 trillion a year. And at the same time, the interest rates are going up. So the interest we have to pay on that debt is going up. So basically, a borrower, as like as a borrowing individual, our credit is going down.
Hey guys, and welcome to the Grow IT podcast. Your host here, Alessandro Cutri, joined today by none other than Adam Ibrahim, a serial entrepreneur. We're going to be diving into a little bit about his story, exactly what they're doing with legacy insurance management, and much more industry insight. So definitely make sure to stick around. This one's going to be an interesting one. But without further ado, I'll kind of just pass it on over to you, Adam, if you don't mind just introducing yourself, telling the audience a little bit about your background and kind of how you got into the space that you are in today.
Yeah, sure, sure. So I grew up kind of just reading a lot of books on finance and investments and trying to just understand the world a little bit better.
Hmm.
And uh, when I was 13, I made my first investment in gold. Um, and it went pretty well, even though I didn't really know what I was doing. And
Yeah.
then I worked on Wall Street for a little while as a teenager, as
Mm.
an intern in institutional sales, and then the Great Recession hit, and
Mm.
I learned a hard lesson about cycles in the
Oh
economy, and
yeah.
and so then I worked some odd jobs and learned a little bit more about administration and management.
Hmm.
Um, and then I built a property management company to put myself through school,
Yeah.
and that went pretty well. And then I sort of used the money that I had earned in my early 20s from property management to start actually acquiring real estate assets opportunistically.
Mm.
So finally getting back into the sort of investment side of things after a number of years, and then that went reasonably well. And then I sort of syndicated those initial buildings that I purchased to start bringing real estate partnerships together. And in the process of doing that, I became acquainted with some insurance companies, and then
Yeah.
I basically saw that asset management in the insurance space was really suboptimal. Specifically in the insurance space, there's a really, like, pun intended, legacy type of asset management approach employed, where they're trying to be really low volatility, and they're trying to sort of do what's always been done in investment management, these asset managers and insurance. And the problem with that is that the world is changing,
Hmm.
and we're coming out of sort of a 40, 45-year period of a certain trend in fixed income that's not
Hmm.
necessarily holding up anymore. And so the whole idea of how you manage low volatility portfolios, endowment portfolios, insurance company, and other institution type assets has to really be revisited. And you
Yeah.
have to kind of take it back to first principles and figure out not what worked in the past, but what's likely to work in the future. And so I saw this opportunity, this one insurance company that I was working with, their asset management really sucked. They were just paying a lot of fees that they didn't need to be paying. There were a lot of intermediaries that weren't adding a lot of value. Um, their sort of mix of assets and their mix of collateral behind those assets was suboptimal. They weren't getting the yield that they could be getting on a
Hmm.
comparable risk profile. And so over a number of years, I built a relationship with this company, and then ultimately built a company to take over their asset management. And the last couple of years, it's been really good. We've
Mm.
outperformed the peer averages by a large margin, almost 100%. And now I'm
Goodness.
trying to kind of I'm thinking about, with the track that we have, to start having conversations with other institutions and insurance companies, maybe even other types of institutional investors in the future to maybe see if that strategy that we're employing could benefit them. And that's
Yeah,
sort of the genesis of it.
yeah, it's interesting to see how things always evolve, right? And what they continue to be by solving, practical problems within a space.
Yeah.
I'm curious though, like, if we rewind the clock back a little bit, what was it that, because you obviously were talking a little bit about kind of your upbringing and kind of what led you to build these companies. Was it something that you always knew that you wanted to, start a company and you wanted to, be a founder and do these things, or where did that, I guess, inspiration come from?
Yeah, yeah. So I was thinking about this, and I think I think it's hard to it's when we think about how we get started as kids and what inspires us as kids, it can be challenging to communicate it because the ideas can seem kind of silly in retrospect.
Hmm.
But to be honest, I think that I grew up in a really financially insecure environment, and I was always kind of looking for some path toward freedom, freedom to have resources to help out the people around me. And there, as a kid, there was always this idea of like finding treasure. Like I had like dreams about like finding great treasures, and it's a lot more nuanced than this, but it's almost like being an investor is kind of like being a treasure hunter. And just
Hmm.
this sounds insane, and I'm sure a lot of other investors might think this is an insane idea, but it just follow me. So you're when you think about what opportunistic active investing really is, it's you're sort of looking really deeply all around the world, and you're acquiring and synthesizing a lot of information. And what you're trying to do is you're trying to see something that nobody else is seeing, right? That's what finding value in any kind of an asset is, right? You're trying to basically find something somewhere in the world that is worth a lot more than people think it's worth. In essence,
Hmm.
there's a value there that's not being seen, right? And in today's day and age, things are very liquid and transparent.
Yeah.
So you're doing this, you're kind of looking at the world, you're learning, and you're trying to basically find hidden treasure in a sense, right?
Hmm.
And that's what finding a great investment is, right? Like when someone invests in a seed stage company that nobody else has seen before, and then they get 1,000x on their investment, they're just seeing something. They're finding treasure. So
Yeah.
I think I was
That's a
like
great point.
hunting for treasure basically. Um,
Yeah.
in and so the idea was that if I could find this sort of value and develop this knowledge, that I could sort of unlock that freedom for
Mm.
myself, for my family, be able to do the things I wanted to do, be able to help the people around me. And so I think that was kind of the origin story of it. And I didn't really know what to do, so I just started reading a lot of
Yeah.
books because I didn't have anybody in my life that set that example.
Yeah, I've asked a lot of people that specific question. And I think you give one of the most unique answers, right? In the sense of, I agree, and it makes so much sense, right? It's always, especially investors, and when you're looking at different companies to invest in, and you're trying to find that diamond in the rough. You're trying to find that, that company that can 1,000x, that can 100x, even can 10x, right? From what obviously you're putting into it there.
Yeah,
Now, I did want you to maybe like, if you could go into a little bit more detail around legacy, insurance, kind of what you guys are doing, and
sure.
really where you say, because I know you talked about it a
Yeah.
little bit earlier, but for maybe for the audience that's, trying to maybe wrap their head around this, like, what would you say that, your value proposition really is as an organization?
Yeah, so it starts by kind of looking at what the industry is and what it was as a whole.
Hmm.
And so when you think about insurance, asset management, and other types of institutions that are sort their capital base needs to be managed in a way that it doesn't take on a lot of volatility, meaning it doesn't have really big fluctuations in value.
Yeah.
What has typically been done is, at least in the insurance company space, is there's been this very heavy allocation to just credit rated bonds and fixed income instruments. And the reason for that is that those types of instruments, historically, the last 40, 50 years, they don't change in value quite as much over periods of economic turmoil and market turmoil. So if you're an insurance company, you probably are trying to get sort of a 3 to 5% annualized yield with very, very little volatility. which
Hmm.
makes sense, right? Because what an insurance company's assets are is they're basically a pile of money that you can't afford to lose because your stability as an insurance company relies on your ability to always be ready to pay out a claim for your
Yeah.
policyholder if something bad happens, right? But the issue with this approach is that it's kind of twofold. The first part of the first issue is that we've been in this kind of 40-year period where rates have sort of trended down on
Hmm.
due to a number of factors. One of the factors being like the really supreme credit of the United States as sort of the global superpower has enabled us to, as a country, to sort of control rate and control value in the space. So if you were an insurance company and you just had a bond portfolio, you could kind of know that over time the rates would sort of trend downward and that would cause the value of your fixed income instruments to go up consistently.
Hmm.
And there wasn't really any kind of risk because there was a very clear path to the way that the machine worked. But more recently, that has sort of broken down, right? So like, for example, over the last year, we've seen the Federal Reserve cutting rates, but at the same time, effective interest rates and treasury yields are actually going up. And
Mm.
so what that is it's sort of a breakdown in the supply demand of debt globally. And so if we kind of dial into that, what's happening is there's so much debt in the world now that it's no longer sort of as easy to control as an asset class
Yeah.
by respective countries, by respective institutional investors. There's this on the whole, what's happening is there's a lot of countries, the US being the lead, running up a lot of deficit. And then the way that you have to finance that deficit as a country is you basically have to issue bonds. Someone has to lend you the money, right?
Hmm.
And so as that pile of debt grows, your ability to repay that debt or your sort of, if you think of like if you're buying a house, the bank looks at the income that you make and they look at, what the debt service coverage is on the loan you're going to take. It's the same thing actually with countries and governments and large
Yeah.
institutions, right? So you can think of like the United States as like one person, right? And our GDP is, I don't know, thirty trillion dollars or something. So
Yeah.
you think of
Yeah.
like the US is like a household that makes $30 trillion. But now we have this debt that's way over $30 trillion. I think it's like $36 trillion, and it's growing by a couple $trillion a year. And at the same time, the interest rates are going up. So the interest we have to pay on that debt is going up.
Yeah.
And so basically, as a borrower, as like as a borrowing individual, our credit is going down, right? Because we have so much debt and it's difficult for us to make the payment. This is actually what's happening. I'm simplifying it a little bit, but
Yeah.
that's
Yeah. Yeah.
literally what
Yeah.
it is. And so how does this all tie into legacy? So what legacy does is it basically says, yes, as an institution, as an endowment, as an insurance company, you want to have really low volatility. But having really low volatility relative to your return, what that means now is different than what it meant before. The
Mm.
environment is changing. So
Hmm.
you need to actually look at other alternatives to get to that best risk reward for these piles of assets.
Yeah.
And so what we do is we start with a basic framework that's sort of acceptable to regulators and acceptable to the industry, which is you still have to be mostly fixed income. You still have to kind of limit how much equity exposure you have because you have to be always dialing your portfolio for a potential 40 to 60% market drawdown and making sure that you can withstand that and have enough capital for your capital requirements. So it still has to be low risk, low volatility.
Hmm.
Then you start looking deeper at the debt stack and you start saying, well, like what else is out there besides just these treasury bonds? You start looking at, senior loans to like which are loans that are made to like small, medium, large size companies that are backed by certain collateral. You start looking at floating rate debt. You start looking at things that are a little bit more discorrelated to an
Hmm.
uncertain interest rate environment where you can kind of get better yield and your collateral position might be as good or better than it would have been traditionally with these sort of Moody's and Standard and Poor's rated bonds. So on
Huh.
the fixed income side, you kind of just get a little bit more diverse. You go to
Yeah.
first principles and you actually look at the collateral that's sitting underneath the fixed income that you're investing in, and you try to find that best risk reward, right? And then on the equity side, you think of it as just sort of like the way any active fund manages equity, right? You kind of you look at the full schema of public equities that are available globally, and you basically are looking at whatever you think is undervalued, whatever you think is cheap.
Yeah.
Going back to that treasure hunting concept, right?
Yeah. 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 Yeah.
You're just constantly learning about companies. You kind of have a number of companies that you think are long-term durable, that are going to do well long-term.
Yeah.
And they all trade in cycles because that's how markets are. Liquidity goes in and out, and sometimes really great companies are able to be had at a discount, and sometimes, really great companies are still great, but they're overpriced and you want to sell them. And so we maintain this kind of portfolio of 30 to 40 kind of concentrated equity bets on the equity side. All of this works together to just create a better risk reward than you would get with a traditional asset management strategy where, say, most institutional investors for insurance companies might just be invested in a series of individual bonds and then some mutual funds, for example.
Yeah. Yeah.
Or they might just be in some ETFs that track the market, which actually do fairly well, but
Yeah.
they don't do as well as a really good active strategy over a long period of time.
That's very interesting.
Yeah.
Yeah. And it's a very, I mean, I'm as you're talking through and the approach that you guys have obviously assembled there, is that something that, a lot of people are, or is this pretty a novel approach in terms of and how you've packaged it here? Or
Yeah.
is
I think
this, go ahead.
you just, like any other, if you want to try to build a great product, I think if you look at what's been happening recently in history, that the people that build really great products, they kind of just scrub the whole thing and then
Mhm.
they rebuild it from first principles, right? So I think what we're doing is novel because there's just been it's a classic pocket of industry where things have just been done a certain way because they've been done a certain way. And that's
Yeah.
the reasoning,
Yeah.
right?
Yeah. Yeah.
That's always a situation where it's ripe for innovation, where it's ripe
Mm.
for rethinking things. Like if
Mhm.
you have any product or service where it's just been done a certain way because it's done a certain way for a long enough period of time, there's a huge amount of missed opportunity there.
Yeah.
Like you just kind of you dial into that and you start dissecting it and you start questioning every part of that product and that strategy. Why
Yeah.
these intermediaries? Why these fee structures?
Yeah.
Why these exposures? And then you
Yeah.
start just uncovering very simple answers, right?
Yeah. Yeah. And
Which is
it's,
like there's better credit at a higher yield here. There's a better equity strategy here on a lower fee basis where you can get more alpha with a little bit lower volatility. And then an endowment portfolio is like you have it's kind of a living, breathing thing where you have these concentrations of different assets that work together and move in different ways. And so the real craft and the work is kind of like you have this block of concrete that you're trying to chisel into a Michelangelo, right?
yeah.
And every day you're just like, do I just kind of reduce exposure to China a little bit and
Uh-huh.
get a little bit more into small tech growth with these companies that I like?
Yeah.
Do I trade a couple of these long duration treasuries for something that's a little shorter duration and floating rate to kind of get a little bit less vol on the. And that's
Yeah.
the job, right? You're just
Yeah.
sitting
Yeah.
there
Yeah.
and you have to love it because I probably spend like 8 or 10 hours a day just reading, right? Like,
And
you know,
yeah, yeah, no, 100%. And it's definitely it's so interesting. I can tell obviously you're very knowledgeable on this topic as well, right? I mean, you live and breathe it type of thing, right? And then that's
yeah,
when you're able to find the pockets of opportunity, right? To when you're obviously inside of it and you're realizing, wait a second, there's probably a better way to go about this.
yeah,
I'm
yeah,
curious to get your take though, because we have a lot of founders, CEOs that tune in and always are looking at different strategies for either marketing, business development, like building relationships. And we have like a really big philosophy over here at Grow IT. One thing that we always say, it's like, hey, it's relationships, pay the bills, right? It's all about getting into the right conversations, getting into the right the right rooms. I'm curious, like what has been, and I'm sure it's probably similar to what you guys are building over there, right? Building those relationships with those investors and different folks of that sort. What have been great, ways for you that have, you've developed those relationships, or what have been some things that you've done that have kind of helped your business continue to grow off the backbone of those?
in my business, institutional level asset management, it's very, very tricky.
Mm,
Business development is very tricky. And the reason it's tricky is because every relationship is really large and
yeah,
it requires a huge amount of trust.
yeah,
So like when you think about like like let's say the two extremes, right? If you're selling like a really simple, cheap product like a
hmm
toothbrush online,
yeah,
the way that you develop business is you run some ad campaigns, you figure out what your CAC is, you put the pedal down where it's working, and you're just developing these like sort of low quality, low touch relationships. And
Mm-hmm.
then you're hoping that there's some word of mouth and some organic growth, and you're making these really small sales, and then you're making your
Yeah.
money on the scale. In the institutional investment management business and
Mm-hmm.
any other kind of sort of scale B2B business,
Yeah.
you have to take a lot of shots with a lot of different people in the industry,
Uh-huh.
and your conversion is super, super low.
Yeah.
And I think that's why it's a very difficult space to get into.
Yeah.
And so for me, it's like my perspective is that you have to have you have to have a modus operandi of like, I'm just going to try to talk to people and ask a lot of questions and try to
Mm-hmm.
learn about them. And by people, I mean just specifically people that are positioned in the industry that you're trying to be in, that you're trying to service, right?
Yeah. Yeah.
But also in general. And you want to, the real way to win business is you want to essentially offer as much help and information as possible,
Yeah.
without
Provide
charging
value.
anything or asking for
Yeah.
anything in return. And that's like, I know that's not like a super novel idea, but I think we lose sight of it sometimes.
Yeah,
Right.
and I think you make a
Yeah.
great point, and it's one of the things that we always reiterate over here, right? There's like if you're selling a low ticket, low cost item, the level of trust that's needed to buy that item is fairly low, right? I mean, maybe you have to like the brand in some type of way. You have to have some type of affinity, but it's not like you have
Yeah.
to make this big purchasing agreement, right? When you're,
Yeah.
in your space or even in some like those high ticket, high relationship based businesses, there's this level of trust that's needed to be built in order for someone to trust that you can fulfill upon the outcome that you say you can or that you can do, right? So there's that element of relationship building that's needed. It's like different. I always use the analogy of with like the B2B space or even like more of the relationship industries, it's often like you're dating, right? So you take
Yeah.
a girl to,
Yeah.
you don't meet a girl on the first date and ask her to marry you, right? She's gonna be like, hey,
Yeah.
dude, like this is way too soon. You're coming on me a little too strong, right? You want to
Yeah.
build the proper like infrastructure, the proper dates, right? You want to go to take her out to dinner, meet her parents before you actually do all that, right? And that's hence kind of what you were saying a little bit of like providing that value in a way, right? Where in a business to business relationship where it's you're showcasing either through your questioning, through the things that you're giving them in terms of assets, that you're continuing to build trust with them to eventually, the actual deal itself, right? So I love that you
Yeah.
bring that up, and I think that that's a big point that is super important for a lot of founders to take advantage of.
I have
Uh,
a more general way that you could think of it across the full spectrum if you wanted to kind of give a framework for all founders across all businesses.
please, yeah.
The framework, the way that you can kind of think of it across the whole stack of commerce is, um, there's sort of a balance between product and distribution. And the balance depends on how high value or how complex your product is. So like there, to give you an example, there, like, let's take two extremes. If you are a crypto scammer, like
Mm,
so many are today, right? Um, like there are like 25,000 cryptocurrencies that have been launched over the last 5 or 6 years. And I
yeah,
think maybe 24,995 of them or something like have no value. And the whole
yeah,
business model there, and just follow me, is it is all distribution and no product, right? Those like meme coins, they don't have, there's no real meaning or product or value. They're like negative
yeah,
sum. But if you're launching one of those, it's all distribution. So it's like you
yeah,
have this thing and you just get as many people as possible to buy it. And then they like, there's like a rug pull and there's musical chairs, and it's like, it's net negative. I don't think it's a good thing, but
yeah.
it's really good for this analogy. And then say at the opposite side of the spectrum, you have, say, um, a company like Palantir, right? Which
Hmm.
is like extremely, extremely loaded into product. Huge amount of technology, huge, huge stack, so much value to the enterprise, big moat. And to get a customer, you had to build this insane infrastructure. You had to literally
Mm,
push an entire technology and industry forward to
yeah,
adapt to client needs. The
yeah.
purpose of this analogy is to say most businesses fall somewhere in between these two spectrums.
Hmm.
And so my business in asset management and private equity is a little bit, it skews toward that much more product.
Hmm.
because everybody wants $100 million client that they can make a
Yeah.
couple $1 million a year servicing. And
Yeah.
so you have to offer a huge amount of value to get that client.
Yeah.
The electronic toothbrush analogy is like closer to more distribution, less focus on product.
Uh-huh.
And so as an entrepreneur in any space, you have to kind of question, how much do I have to put into product and how good does my product have to be before I can then focus on distribution? And it
Hmm.
really depends on what the product is. And I think it's really important to stress this because everybody kind of wants to have like the human condition is like we want to have a framework of like something that works across the board. I think in sales and business development and distribution, it just doesn't, there is
Yeah.
no sort of strategy that works across the board, right? If you're selling a low value item, it's all about distribution. If you're selling something that's extremely high value, it's all about product because you have to really differentiate and add that value and justify it. So if you're going B2B,
Totally agree.
yeah,
Yeah, yeah, yeah. Because I mean, at the end of the day, right? You can't. I mean, you're not able. You can't outsell a bad product, right? You can't outsell like a
yeah,
product that's not going to resonate with the market, right? It doesn't matter how good you are at sales, no matter how good you are at marketing, right? If people don't see the value inherently within the product that you have, you're never going to be able to sell it to anyone, or it's going to
yeah.
be
And that
you're never
hurdle
going to find
depends
that.
on what the product is, right?
Exactly, exactly.
Yeah,
Hey, Adam, I think that's probably the perfect note to end on. I think that there's a lot of value that people can take away from that itself when thinking through, what they're building and how they're building and the different innovative ways that they can go within certain, legacy industries that are out there and how to figure out the gaps of opportunity for that. Similar to what you guys are doing over at Legacy Insurance Management. I definitely think it's something unique, and I'm always a big fan of very novel approaches. So if people are listening to this, man, they want to check you out. They want to check you, maybe, you guys out or, maybe follow you on some socials. What are the best ways to go ahead and find you, man?
well, I'm on Instagram. I'm on LinkedIn. You can always shoot me a DM on one of those platforms. Um, and as far as legacy being that we only are facing institutions and particularly insurance companies right now, we don't have any kind of marketing or solicitation. So I guess it would just start with having a conversation. If you think that you could benefit from kind of revisiting your asset management strategy, if you're sort of an institutional grade investor, if you want to share ideas, my communication channel is always open. We can just share ideas, and if there's a fit somewhere, if I can add any value, I'm happy to do that.
Awesome, dude. Well, I'll make sure to include those links in the description for people to go check out. If you did make it all the way to the end, guys, make sure to like, comment, and subscribe for more content. Go check out Adam and the team. It sounds like they're definitely doing something special over there. So we hope you guys have a great rest of the day and take it easy. Ciao, ciao.